Okay, good afternoon, everybody, and welcome to our Emerging Risks webinar. This is our second webinar of the year, and today we're looking at climate-induced catastrophes and the protection gap. I'm going to go over some housekeeping items. Danica is, my colleague Danica Hall is working behind the scenes, popped up the agenda. Thank you for that. So I'm going to work over the housekeeping items and then pass on to Alistair Campbell. Our CEO is going to welcome everyone to the broadcast, introduce our speaker, Mary Kelly. And we're going to close the broadcast looking ahead to our September 11th Risk Officers Forum meeting, and then just briefly talk about the satisfaction survey that you'll receive following the broadcast. So everyone is familiar generally with how this operates. You see at the top of your taskbar the chat, the Q&A, and the raise hand function. And we want this to be an interactive broadcast. We certainly ask you to make use of that. We have about 140 plus people registered for the event from 60 something companies right across Canada. So welcome everybody and welcome to first timers. Hope you enjoy the next 90 minutes of discussion. In terms of housekeeping, we have the Competition Act, which is in effect throughout the broadcast. You are and remain competitors throughout the broadcast. This is going to be recorded. You will receive a copy of the slides in a follow-up email. And we're going to be using the Menti app. Our speaker, Mary, is going to use the Menti app, and it also has a question and answer and a chat function. So when that is up, you can use that also to pose questions and provide comment. So now I'm going to throw over to our CEO. He is out and about. I understand he's beaming in from Bermuda. So Alistair Campbell, over to you. And Alistair is going to say some words of welcome and introduce our speaker. Thanks, Alistair.
Thanks so much, Ian, and hello, everyone, and thank you for joining our Emerging Risk webinar today. We feel like we have been curating a decent set of topics over the last while with quality speakers. The feedback you give us from the surveys we send afterwards is deeply appreciated, and we're particularly excited about this event today. The topic of protection gaps is a subject of global attention. The wildfires in LA most recently exposed again that even in the most wealthy developed economies, substantial protection gaps can exist and may in fact be increasing as a result of climate change fueled catastrophe perils that are rapidly evolving and maybe occurring outside historical models. And so the protection gap topic is very live. In Canada, obviously last year's July by itself was the worst year ever, and a sobering reminder that we can have secondary perils, as you think about them, occurring everywhere at once. And in larger scale than perhaps historically we're familiar with. And so this is a global issue. It is an issue for developing and developed economies. It's definitely an issue for Canada. We watched the platforms of both major parties in the last election specifically talking about protection gap issues, committing to things like flood programs. So it's very clear that the issue is international, it's specific to us. And at the point where we start thinking about what these special programs could look like, these public-private partnerships that IBC is doing such excellent work to move forward with the federal and with provincial governments, you're very aware that at the moment we get to the kind of coalface, there are actually a whole series of difficult public policy issues to address around mandatory or voluntary coverage and how much subsidization and who's doing the subsidizing. And if there is a public share, is it at the burning layer or is it at the excess layer? And is that different by peril? And so there's a whole set of really fascinating public policy issues that our industry is going to need to come to grips with quite quickly, because we are on the verge of getting yes to the general request that we've been making to government. And that's going to lead to a whole bunch of questions about what specifically are the right policies to implement for our country. Now, one last point to make before I introduce Professor Kelly, which is that at PASIC, we are all contractually obligated to talk about quake at all events. And so while Professor Kelly initially pitched us a climate cat topic, we have encouraged her to include quake as one of the perils to consider more broadly, and she has been good enough as to agree to include that as part of the agenda for today. So sorry for that long intro, but let me just get to it and introduce Professor Kelly to you. She is a professor in finance and insurance at Wilfrid Laurier. I think a bachelor's in math, a master's in math, a PhD in even more complicated things as well. Taught at University of Calgary before she went to WLU, I believe. Just to reassure all of you, she worked as an actuary before she became an academic. She's chair in insurance at the Laurier School of Business and Economics that has a concentration in insurance and risk management. She's a member of all the right international associations where her expertise is highly respected. And she has been, I hope many of you noticed, writing outstanding pieces in our quarterly Solvency Matters newsletter. So her written voice will be, I think, familiar to many of you. But we're thrilled to have Professor Kelly live with us this afternoon. So Mary, thank you for joining us and really looking forward to this session. Over to you.
Thank you very much, Alistair, and thank you for the kind words. And thank you, everyone who is attending this. As Alistair said, I did slightly change the name of this presentation to be Earthquakes, Climate-Induced Catastrophes, and the Protection Gap. Although I joked with Alistair, it was because, I'm contractually obligated to talk about earthquake. Really when we think about where our private market insurance products aren't working, it's not just some of the climate-induced catastrophes and mainly flood, but it's also earthquake where we have a significant protection gap. So hence the reason we're going to talk a bit about earthquakes and a bit about some climate-induced catastrophes. Next slide, please, Tanika. So we are going to be using Menti today. You have two ways that you can use it. If you'd like to use Menti on your smartphone, you could just scan the QR code and it'll bring you straight to that page. If you prefer to follow along on your desktop, you can actually go and go into menti.com and you can enter that code. So I'll give everyone a minute or two to get into the Menti. We'll be doing a series of different group events with this today. Danica, can you see how many people have joined in?
I'm not sure that I can until we're actually doing one of the Mentis.
Okay. Well, let's go to the next slide, because the next slide I still have the QR code there in case people haven't managed to download it yet. But really, why are we here? Well, we all know that 2024 was the costliest year to date for insured losses due to the weather events, and insured losses totaled over $8.5 billion, which is a never before seen number in Canada before. So the climate-induced risk is rising, and we know that the protection gap is widening. And we worry a lot about insurer solvency and consumer affordability. They're at risk both from the changing climate, and also we think about earthquake. We know we haven't had a significant earthquake in Canada yet, but we've all seen the PASIC modeling on how that significant quake has a capacity to take down the Canadian insurance industry. And really, the time for government to rethink government intervention in insurance markets is now. We shouldn't wait till we have an event. We should be proactive about it. So what I'm going to do today is walk you through some different global approaches and assess what role, if any, the government should play in supporting catastrophe insurance, which I've shortened to CI in Canada. Next slide, please. I just want to take a minute to really frame the challenge that we have here. Well, we've had residential flood coverage now for just roughly a decade, but we also know it's not universally available. High-risk properties are often uninsured or underinsured. We have had a federal announcement that, there is a national flood insurance under development. But to date, we haven't seen anything. And we know that there is a need to provide that coverage. If we think about earthquake, we've got several different challenges. The first, we've got 2 major earthquake zones in Canada. Most people who live in Quebec don't know that they actually live in a major earthquake zone. And so earthquake insurance take-up is in the single digits. Clearly, that's a significant protection gap. When we look at British Columbia, we do have higher take-up rates, roughly around 60%. We know that is actually going to create a tail risk issue. But the other concern is even where people have been able to purchase insurance, because of policy provisions such as high deductibles or the exclusion of the secondary perils, even the fact that all earthquake shocks that occur outside of a 160-hour window after the initial shock would be considered a new event. So even those people who have coverage, the coverage is not adequate. And added to that, the fire following uncertainty and those exclusions again, that creates a significant gap in protection. Next slide, please. We have had some significant wildfires in the past. Horse River in 2016, we had Jasper last year. If you look at the recent wildfires in LA, there were 14 wildfires that swept through Southern California in 3 weeks. Total economic loss is estimated right now to be $50 billion. If you actually look at the California insurance market, a combination of those recent events, as well as the regulatory intervention into residential property insurance in California, has had primary insurers pulling out of the market. Could that happen to us in Canada? So will wildfires still remain part of the standard coverage, or is the availability of coverage at risk in the future? So these are some of the concerns that we have in Canada. Next slide, please. So our first Menti challenge is going to be asking you what perils are hardest to insure. So I believe you're allowed to pick 2 or 3 different choices here. It should show up again on your smartphone, or you can use that Menti code at the top to join if you haven't already joined. It looks like responses have slowed, but as you see, looking at this, about a third of the participants are saying earthquake and flood, another third are saying wildfire, and then the remaining third is actually split between the 2. I think what this shows is that all 3 of these risks or perils are of significant concern in Canada today. And I think these will be available to you afterwards, just like we received the Menti outcome after the last Risk Officers Forum. Next slide, please. What I'm going to ask you to do here, though, is say, what do you think is the biggest barrier to catastrophe insurance reform in Canada? So you're allowed to enter as many responses as you want, up to 200 words, but how this Menti is going to work is after people start answering, if you see someone put an answer up and you say, oh, that's what I want to say, we'll have a chance to vote on people's answers here. So we'll give a few minutes so people can put in what they think is the biggest barrier to reform in Canada. So who subsidizes who, appropriate risk maps, the cost, slow government response, lack of wildfire modeling. Wow, they're coming in faster than I can read. But I think, Danica, you can actually scroll down so you can show people the other answers, and people, I believe, can scroll down on their own devices to see the answers to? I'm not seeing any new answers come in. Danica, do you want to press enter to start voting? And then people, I believe, can vote on their top three. And then once we finish voting, we'll see what this people think the top three are. Danica, I think if we press enter to show the results, people can still continue to vote. I think the numbers are changing. So three sort of float to the top, the cost, which we'll talk about some solutions to address that. Appropriate risk maps. I think we all agree that that's larger than just an insurance industry problem. And public awareness of high-risk zones. We'll just talk a little bit about that. I have a little bit on government responses, but we'll try and talk about some of these issues. Could we go to the next slide, please, Danica? The good thing is we don't have to reinvent the wheel. So what I want to do here is start thinking about, well, why and how do other countries intervene in catastrophe insurance markets? So clearly we're not alone in facing these climate-driven challenges. Other jurisdictions have tackled similar problems with varying degrees of success. So what we're going to do now is examine international models because they might help clarify what's possible, what trade-offs exist, what may or may not work in Canada. So the next thing I want to talk about is what are governments actually trying to achieve when they intervene? Next slide, please. So if you think about it, we really have 5 fundamental overarching objectives why governments would intervene into catastrophe insurance markets. One is to expand availability, and typical interventions we'd see there would be a government insurer, typically the sole insurer of that catastrophic peril. We could see a residual insurer, so the government could set up an insurance company just for high-risk insureds. And we've also seen countries set up mandatory pooling. So if you set up mandatory pooling with the low and high risks, that's a way you could distribute the costs across the entire industry. We could be looking at improving affordability, and typical interventions would be having a government reinsurer that provides subsidized reinsurance, and we could have a mandatory pool with cross subsidies, again, to help those high-risk insureds. The third objective would be to protect solvency. So typically when we see an intervention to protect solvency, we see the government coming in some sort of form at the tail end, either as being an excess loss provider or providing some sort of financial backstop or a liquidity provider where they will fund the losses but expect to be paid back over time. We often see governments intervene to reduce the protection gap, which is somewhat similar to expanding the availability and affordability. Typically, we would see a mandatory offer, so individuals don't have to purchase the insurance, but insurance companies have to offer it. Typically, that's done with a sole insurer reinsurer model. And again, we could see some public pools. So we're starting to see some interventions that can solve many different problems. And the last objective we see is governments entering to help encourage mitigation. A lot of these activities happen outside of the insurance market, so there could be direct financial incentives for mitigation, building codes, land use policies, and risk communication. Next slide, please. So the both policy goals and the nature of the peril will actually shape what this program is going to look. So we think, for example, why the interventions might vary. If we look at Florida, we know that there are a lot of problems in Florida, but many of these are exacerbated by the fact that by the peril itself of hurricane. So hurricane losses are large compared to both the domestic and global insurance markets, and the return period can be very short. It's possible to have a year with many, many hurricanes, so that is a very different problem to solve than if we had a peril of earthquake where the return periods are very long. So these peril characteristics are going to place limits on what interventions are feasible and sustainable. And if we think about like wildfire or flood, right now they are insurable, but in the future with climate-driven trends, that could threaten the long-term insurability. So the end result is both these policy goals and the nature of the peril will shape what the CI program structures look like. Next slide, please. I'd like to go just a little bit more into the nature of the peril. And why does this matter? Well, it's not a design feature, but it's going to shape what interventions are feasible. And for us, thinking about the Canadian concept, it's going to mean that solutions that we may come up with for earthquake are going to be fundamentally different than solutions we might come up with for flood or wildfire or any sort of wind damage or hail. So the first one that I have is, how is it treated in standard insurance contracts? So is a peril actually part of the standard contract, such as wind or fire? Can it be added by endorsement? So we could talk about flood or earthquake, or is it excluded? And we could talk about some of the secondary perils associated with earthquake. If we talk about a mudslide or rock slide, which is excluded. What is the size of the potential loss? So could a single event or a series of events occurring within a short period exceed the capital capacity of the domestic insurance market or the global reinsurance market? Again, when we think about tail risk for Canada, we think about earthquake. We don't really think about flood as creating a tail risk event. So the actual design decision could be different for those two perils. What is the return period and frequency? How often do these events occur, and how quickly must capital be replenished? That's actually going to have a significant impact on what sort of funding models that we can come up with. And what are the trends in insurability? Are there climate trends that in the future will make this peril increasingly uninsurable? What that means is that we may have a solution today for this peril, but this solution may not work next year or the year afterwards. Next slide, please. So my interest in this topic started with a project for Finance Canada, looking at how to support the resilience of the Canadian insurance industry. So what we ended up doing, we did an examination of 20 catastrophe insurance programs across 17 jurisdictions in the world. We only looked at programs in developed economies. There are lots of government programs in emerging economies, but the focus of those programs and the problems they're trying to solve are quite different. I will say that the one restriction that we had is that we really only looked at programs if the information was available in English or French. If we couldn't get any information in English or French, it was really not available to us. And the other thing we tried to do is catalog different interventions globally. So what I want to do over the next 5 slides is outline a set of key structural design choices that shape catastrophe insurance programs. For each, I'll highlight how different jurisdictions have approached these decisions. I think it's important to say up front that when we talk about government entities entering the catastrophe insurance market, it doesn't look like private insurance. And really, it shouldn't look like private insurance structures, because the goals and mandates, the financial frameworks available to governments differ in fundamental ways, which really influence how they participate in all different elements, such as coverage, pricing, and risk bearing. You'll see that some of these structural choices are overlapping a bit. I just tried to capture in as many ways as possible, what governments actually did. So on to the next slide, please. So the first design choice that we can talk about is what is covered and who provides it. So this is going to shape how insurance reaches the public and what perils are included. So what perils are actually covered by the public entity? In some jurisdictions, such as France, Iceland, Spain is the same, there is a defined list of catastrophic perils, and if that peril happens in that defined list, it's the named peril approach, then the government will cover those losses. In other jurisdictions, such as Japan for earthquake, UK clearly flood re, and terrorism insurance in the US, it is a single peril coverage. So only that peril is covered by the government intervention. The next design choice is how do we actually cover those perils? In some jurisdictions, and I give Belgium, Iceland, and New Zealand, it comes as part of the standard. Well, for New Zealand, it's residential. Belgium, it's residential and small commercial. Iceland, it's everything. It's actually bundled with that primary policy. In other jurisdictions, the CAT coverage can be optional. So if you think about the California Earthquake Authority, you buy earthquake separately as an endorsement, similar to Canada. In Canada, flood is separate. You don't automatically get earthquake. And in the US also, the National Flood Insurance Program. I'll put a little asterisk beside that because if you've ever received funding from FEMA in the US for flood losses, you are supposed to, by law, actually it becomes a compulsory coverage for you to buy. So who do you actually buy your primary coverage from? There could be a mandatory public insurer, such as Iceland. So the NTI in Iceland, they are the only provider of earthquake insurance, and you have to buy it from them. There could be an optional public insurer, so the California Earthquake Authority. Costa Rica also has a national insurer that competes alongside private insurers to offer all coverages. You could have a public-private co-insurance mechanism, and that's what's in place in New Zealand. So you would get private insurers offer earthquake coverage for the contents of a home, and you get Toka to Ake EQC, the government insurer. They actually provide the first layer of coverage for the dwellings. So it is split that way. In other markets, such as Belgium and Denmark, and Belgium is interesting, there's no government insurer set up, but they have a sharing agreement that primary coverage is provided by the private market, and then direct public funding is just given to the insurance companies to pay for losses. The last thing I want to talk about on this slide is how is a program funded? So when we say it's pre-funded, like the ARPC in Australia and the CEA, that just means premiums are collected up front and reinsurance could be purchased. The Terrorism Risk Insurance Program in the US is post-funded. There are no premiums paid up front. If a loss happens, insurers are responsible for a portion of it. The federal government steps in and pays the next portion of it. And primary insurers have to pay the federal government back over a series of years. Or we could have a combination of the both. And we see that actually in Florida with both Citizens and with the Florida Hurricane Catastrophe Fund, is that there's upfront premiums. But if those aren't sufficient to pay for losses, FHCF can actually issue bonds, and Citizens can actually put levies on all policyholders in the state of Florida. So there is some post-funded mechanism there. Next slide, please. This is where it gets really interesting, at least I think. So who does what? So again, this is where we can't really think about it. Our normal definitions of primary insurer or reinsurer, because that falls apart when we look at government intervention. So who actually prices the coverage? Who is responsible for setting premiums, or however, these are rarely actuarially based, but who sets the premiums? Well, it could be the public entity, which is, I give you 3 examples there. It could be the private market, so the Belgian voluntary market in France and UK, they set their own premiums. Or we could have the private market sets the premiums, but there is some government, I'll say, constraints on it or oversight. And we see that in the Australia cyclone pool, and we see that in the Belgium high-risk pool. Who actually underwrites the policy is the next decision. So if we look at CEA, we look at Iceland, they actually underwrite that policy. They figure out CEA is actually completely actuarially priced, so they figure out that actuarially price. The private market in Australia, France, and Spain are the ones who underwrite that policy, and the shared in Belgium, the low risk policies are underwritten or priced by Belgium, and the pricing model is set by the government for the high risk pool. So who settles claims? So it's very interesting. Spain would say that it is a reinsurer, the government entity, but they actually settle claims directly. And Iceland, the NTI acts as a typical insurer. They underwrite, they price, and they settle claims. The CEA, despite pricing and underwriting the policy, they're not involved in claim settlement at all. It's done by the private insurers who are affiliated with the CEA in California. And again, it is shared in both Costa Rica and New Zealand. Last element I have here, and the wording is a bit clunky because I didn't really know how to phrase it to capture the nuance, is if there is a government financial role, the government actually provides some sort of funding or some sort of support, how is it actually provided to the private market? Well, I say through actuarially-ish price reinsurance in Australia and France. So Australia has cross subsidies that are based at the property level, but it starts with an actuarial pricing framework. In France, they actually do that actuarial pricing at the national level, figure out how much money they would need overall, like nationally, and then they use some sort of flat pricing model to collect that much money. There are different loss sharing formulas in the Belgium high risk pool and in Norway on how those losses are shared across the different companies. Norway operates very similar to facility association. You know, losses are paid sort of by the pool, and anything left over more or less goes back out to insurers. Or we could have post-event transfers without risk-based pricing. Again, in Belgium, they just give money to the primary insurers if losses exceed a certain threshold. And TRIP, as I've explained earlier, is also that post-event transfer without any risk-based pricing. Next slide, please. So I've already talked a little bit about this. Again, as I said, there's a little bit of overlap because the programs don't all fall into nice, neat categories. If we actually want to think about a pricing model or a pricing approach, you know, what different pricing approaches exist out there, and these choices will affect fairness, incentives, who bears the cost of a catastrophe risk. So if we look straight at that property level, because I said France does something sort of weird, if we look at actuarial-based pricing at the property level, the CEA does actuarially based pricing. There is a new rollout of the U.S. National Flood Insurance Program called Risk Rating 2.0, and that is supposed to be priced actuarially. In Spain, there is a flat fee per policy that's collected, and that is used to pay for catastrophe losses. In many jurisdictions, there is a flat surcharge. So there's a surcharge, or the flat charge based on the per dollar insured amount. So that's in Iceland, New Zealand, and Norway. So it's set as New Zealand is I think it's a $3 per $100 of coverage. And in France, there is a premium surcharge, which right now is 12% of all property premiums. Are premiums actually cross-subsidized? And there's different mechanisms that we could have to set up cross-subsidization. In flood re, the subsidization comes from a levy on all policyholders that's actually used to pay for some of the losses for the high-risk policies. There is a structured mechanism within the Australian cyclone pool that actually transfers funds from the low risk to the high risk to bring down the premiums for the high-risk insureds. And again, the CEA has absolutely no cross subsidies. So earthquake insurance is actually fairly unaffordable for a lot of households in California. And, you know, one thing that I think is important to think about, which falls a little bit outside of that pricing, but are there regulations in place that actually impact affordability? So if we think about the very high solvency requirements in Australia, in Canada, so Canada's a 1 in 500 year earthquake. In New Zealand, private insurers have to carry enough funds for or heavy enough reinsurance for a 1 in 1,000 year earthquake, that clearly is going to push up the cost of insurance. Another thing that pushes up the cost of insurance is a lack of capital relief from any sort of insurance-linked securities. Most jurisdictions allow for the use of cat bonds to actually, to play into any sort of solvency testing. Canada alone, as you all know, there is no capital relief from cat bonds. It would not impact your MCT if you were to issue cat bonds. Next slide, please. So just a few other design choices. Is participation mandatory or optional? There's a mandatory offer, which means insurance companies have to offer it, but individuals or companies don't have to buy it in Australia, California, and TRIP, with both the Australian terrorism pool and terrorism coverage in the US. Most commercial entities actually do buy that coverage. CEA, the take-up rates for earthquake insurance sit about 10 to 12%. So the take-up rates are pretty low. So a mandatory offer is not going to solve any sort of participation gap, protection gap. Is there a mandatory purchase requirement? And we have mandatory purchase requirements in Belgium, Iceland, and New Zealand. And if you think about, do you have to buy coverage for that catastrophe peril? We know right now in Canada that most insurers are still offering earthquake coverage, but they're not compelled to. So it's still a voluntary market. And we've got, sort of touched on this earlier, our losses pooled. There's a national all-risk pool in Norway. There's a high-risk pool in Belgium. There are centralized reinsurance pools, both the Australian terrorism pool and UK's pool re, which is also terrorism coverage. But most jurisdictions have no formal pooling mechanism in place. And I think the next one, which could be important for Canada, is the program nationally consistent? So if you look at Australia, Denmark, New Zealand, there is one catastrophe insurance program that covers the whole country. But there is, for example, in Switzerland and most US catastrophe insurance programs, when I talk about in the US, I talk about California, or I talk about Florida. That's because they're at the state level, and this regional variation might be important if we think about earthquake risk in Canada, but maybe not flood risk. Next slide, please. So the next piece that I want to talk about is, and it's the last one I want to talk about, is the idea of managing solvency and managing resilience. So these actually are going to influence long-term sustainability, market participation, political viability. And so where does the government participate? If they participate in paying claims, where do they sit? Both CEA and Iceland, they sit at that initial layer. They pay from the bottom up. A primary shared coverage is in the California Share Fair Plan. So in California, after all these companies start to withdraw, their Fair Plan, which is a residual insurer, start to offer wildfire coverage. Much like the whole concern over flood and hurricane, because the Fair Plan coverage is a named peril coverage, it is possible there could be a wildfire where some coverage would be covered under a Fair Plan and some coverage for an individual property could be covered under the primary insurer, which we know creates significant difficulties in claim settlement. And in New Zealand, I've already explained how dwelling is covered by the government insurer and the private market covers the contents. The Australian terrorism pool and in Belgium, they participate in a capped upper layer. So the primary insurers are responsible for the first layer, and that first layer actually changes by insurer depending on the size of the insurer. And then the government comes in for the next layer. TRIP again is an excess layer co-insurance. So the primary insurers pay an initial layer, and then above that layer, the federal government pays 80% and the primary insurers pay the next 20%. And in France, we have a full reinsurance. So they cover all the losses. So who is responsible for tail risk? The government for both France and Japan assume that tail risk. private markets in California and Norway. And what I mean by that, the CEA has enough reinsurance for a 1 in 350-year event. If there is a quake greater than a 350-year event, then that gets put back onto the private markets. There's no coverage available there. Or policyholders and claimants in the California Fair Plan and in Florida. And by that I mean, losses could be prorated, or you would have these ex post assessments on claimants or other policyholders. And we have a shared model in New Zealand because the Tokatu Ake EQC, the government insurer, has a full government backstop. Private insurers have no backstop. So again, how's that resilience supported? That backstop in France and Australia. There is public or private reinsurance in Denmark, Iceland, New Zealand, private market, and there's a combination of the government provides some backstop and reinsurance market provides some backstop in Japan. Okay, next slide, please. So I think the last point that I want to make, and it comes back to an earlier discussion about mitigation, is regardless of what policy goal that the government prioritizes, programs are going to be stronger when they think about, risk communication. So how do the entities actually, let people know about the risks that they undertake? It's actually part of the mandate of the New Zealand public entity, and UK Flood Re runs campaigns so that people know they live in high-risk zones. When any sort of catastrophe insurance program sort of supports mitigation, we tend to see more robust systems. So 2 examples I give you here are the CEA has a bolt and brace program for earthquake, and UK has a Build Back Better program. And the last thing, when we get some regulatory flexibility to free up capital and supports innovation, Norway has a really cool mechanism. They can build up tax-free catastrophe reserves over time. So if they don't have to pay tax on that, that actually reduces the cost of insurance. And if there's surplus relief from cat bonds, then you would also see it's going to free up capital, which could actually improve product design. Next slide, please. So where we are now, that we've sort of framed some of these key design levers that governments could use to manage catastrophe risk. What I'd like to do now is highlight some, bring us back to that discussion we had at the beginning. What do we think is missing in Canada? Again, we're the only G7 country without any intervention in catastrophe insurance markets. So what does this actually mean in practice? We know we have a persistent protection gap with flood due to both affordability issues and supply side constraints. Some high-risk properties just cannot get flood insurance. Again, insurance should be for an if event, not a when event. We've had this federal program announced, but its key design elements are still undefined. Just recapping what we know about earthquake, we have a high take-up in BC, but we've got these policy provisions that reduce the real value of that protection. In Quebec, we've got this low take-up, at 5 or 6%, that contributes to a significant protection gap. We have tail risks that threaten solvency, especially in BC, and especially, it's exacerbated by our 1 in 500-year capital requirement. And then the inability to count alternative capital sources like insurance-linked securities towards capital relief further increase costs. And I'll just throw that wildfire out again. The California experience is really how a bundled coverage plus regulatory constraints lead to market failure. And I think we have to ask, could we have market failure in Canada? We've all heard that the government's talking about having more oversight of personal property coverage. Could that actually lead to insurer withdrawal? Okay, next slide, please. So before we turn to potential policy options, I think it's, important to sort of clarify what problems are we trying to solve here. So, because how we actually define the problem will actually shape what solutions might be viable. So, is a key problem, and we did that little Menti activity earlier, is the problem going to be affordability or availability? And really that, again, so the focus is going to be on making coverage accessible to households. So if we think about flood, that could include explicit cross subsidies. We could have levies on all properties with the proceeds of those levies going to pay for high-risk flood properties. We could have flat pricing models. We could have some sort of income-based support. Some people who live in high-risk zones might be able to afford the cost of flood insurance. Policy responses for earthquake might include lowering the capital requirement or allowing catastrophe bonds to provide surplus. Policy responses could include government participation through direct premium subsidies, reinsurance support, or backstops, which would reduce insurer capital costs and expand private market capacity. Next slide, please. So just some more problems. Is a problem that we're trying to solve a solvency problem or a tail risk. So really there, what we want to do, we want to focus on ensuring that after a big event, the private insurance market remains solvent. Now, some insurers could fail, but we want an overall robust, resilient market. I'll say that the best policy response there is a backstop or a guarantee. But we could have co-insurance or other ex-post capital transfer mechanisms that could also support that resilience. Is the problem actually the policy provisions that those contractual policy provisions? So individuals may purchase coverage, but that coverage is so restrictive that we haven't solved that protection gap. If you think about earthquake, it could be lower deductibles. If you think about flood, it could be higher limits. If you think about earthquake again, it could be the inclusion of the secondary perils or an expanded window event. And by that I mean remove that. I have 72 hours. That should be 7-day reset for earthquake. Sorry, I have a mistake there. Next slide, please. And this was actually highlighted when several people said, the problem actually sits with the government. So is a problem a lack of political appetite for mandatory solutions? If that's the case, then should the focus be on enabling voluntarily or locally tailored models? So it could be an opt-in coverage. There is something I haven't really covered here called community-based catastrophe insurance, where communities can get together and buy at the municipal level their own insurance and use the funds of that insurance. They could do things like cover the deductibles of people who have purchased into that plan. Or they could actually use the money from that for uninsured assets, or typically uninsured assets, to pay to rebuild them or repair them after a loss. Are there different sort of incentives that we could put in place for voluntary take-up? Is the problem actually political delay or feasibility? If that's the case, what are implementable solutions? Where can the insurance industry come to the table that will say that we've got some technical sound solutions that will work with political and institutional realities? So these could be some of those post-loss funding models. We're not asking the government to commit to funding up front, but what we're asking for is the government to create a mechanism that we know will be in place after an event happens. Is it some sort of layered risk sharing where the primary market says we can handle this much risk, but we're going to ask the government to come in and take some of the upper layer pieces? Or is it some sort of hybrid public-private delivery? Next slide, please. So where we are here is that I'm going to ask people to start to look at what we'll go into flood itself. And what do people think is the biggest issue for flood? So what this allows you to do, if you don't have to pick your favorite, you can actually rank order 1 to 5. And understanding that different stakeholders may prioritize these issues differently. And that's okay, because I think this lack of consensus may help explain why we don't have a flood insurance program yet. And why, we still don't have a backstop for earthquake. So I'll ask people to vote to rank order what they think the biggest challenge is for flood. We'll just give it another minute or so if people still want to vote. So thanks for these responses. They give us a good sense of what the room sees as a core challenge. Clearly affordability, coverage limits, and availability. So these issues should shape how we think about solutions. So I'm actually going to turn the question around now and think about, if we had a clean slate, what should flood insurance actually look like in Canada? So can we go to the next slide, please, Danica? Okay. So what should flood insurance look like? Well, should we have, if we were to design something, should we have mandatory flood coverage? If we had mandatory flood coverage, we're getting into some trade-offs here. This encourages high participation, broad risk pool, but it may face political resistance and that affordability issue that we said was critical. Should we have a reinsurance backstop for private insurers? It keeps the private delivery intact. It lets insurers do what they do best. It manages tail risk. But unless it's paired with subsidies, it's not going to solve that affordability issue that we've highlighted. Should we have subsidized coverage via a public reinsurer? So this improves affordability, it leverages private insurers, but it may require public funding. And so there's a political component to that. Should we have a flat rate bundled coverage right within a primary insurance policy? It'd be easy to implement and understand. It could be perceived as fair by some, but if it's a flat rate coverage, then clearly what's going to happen, we're going to get overpaying by low risk households, and we lose any sort of incentive for mitigation that you tend to get from risk premiums. Should we have a voluntary model with subsidies? That may be politically feasible and flexible, but there might be a continued risk of low take-up in high-risk zones, depending on the size of the subsidy, and it doesn't answer the question, who pays for that subsidy? So can we go to the next page, please? So here's another chance for you to think about what we've talked about, what might work for Canada, and just like the last one where we had voting, what design features or interventions do you think are actually viable for Canada? People can start putting in interventions they think would work, and then after we get a full catalog of interventions, then Danica will open it up so people can actually vote for what they think would work in Canada. We'll give it another minute for people to enter any other possible interventions. Danica, maybe we should open the voting now? And so here again, people can vote for their top 3 favorite. I think we're getting some pretty clear results, and voting seems to have slowed down. So Danica, did you want to show the results? And it's interesting because subsidy appeared a few times. So I imagine we could group all the subsidies together. We get a clear winner, the subsidy via a government reinsurer. So this isn't on a slide that I have, but I think I'd like to highlight what they do in Australia for the cyclone pool, because I think it's a really interesting solution. So the Australian government decided to set up they already had a pool for terrorism coverage. They decided to set up a pool for cyclone risks. And they had the north of Australia has a significant cyclone problem. And people were unable to find insurance. So what the federal government did, they set up this pool to provide reinsurance. They first went and they priced reinsurance at an actuarially fair level for all properties across Australia. Now, for the low risk insureds, the premium that they charge for reinsurance, it's a mandatory pool, everyone has to join it. The premium that they charge is basically the same premium that would be charged on the private market. So if you're low to moderate risk, then you don't see any change in your premium. But because this entity does not pay taxes, does not have to have the same solvency requirements because it's a government reinsurer, clearly it's cheaper for them to be able to offer reinsurance than it would be for a private company to offer reinsurance. So what they do is they can actually say, well, here's what we're charging our low risk insureds, which would be the private price. What we'd actually need to charge them is something below that level. And then they take the difference between what they're charging them and what they have to charge them from their own modeling, and that becomes a subsidy to the high risk. What's neat about this model, what I like about this model, is that yes, if you're low risk or moderate risk, you are subsidizing the high risk, but you're not seeing a change in your premium because you are still being charged that reinsurance premium that you would be charged in a private market. So I think it's a really innovative design solution. Clearly, what it does need, though, it has to have complete participation of every insured across the country. The next one is mandatory minimum coverages. I think that, again, if we could solve this affordability issue, then I think we'd have more, it'd be easier for insurance companies to offer mandatory minimum coverages to everyone. And clearly flood maps are significant. We need to know, be able to price the risk accurately. And I think the industry has been asking for that for a very long time. So thank you for all those responses. They really highlight some thoughtful ideas about matters, things like affordability, things like there were some incentives down there for mitigation. So let's go to the next slide, please. So given what we've seen in other countries and the specific challenges here, what are some problems that we actually have to answer? So we have this affordability from the government's point of view versus their fiscal exposure. How much should the government subsidize versus allowing market prices? So these are questions we're going to have to answer to make flood insurance work. Should there be voluntary or mandatory participation? So we know high take-up rates reduce the protection gap. It improves risk pooling. But we also know that mandates are politically very sensitive. I don't think there's really an appetite for a flat pricing model. That would be easy to implement. But I think there's a fairness concern for low-risk households. And again, that private delivery versus public control. It's really important to think, if we want the government to participate in this, do we want them to act as a reinsurer? Do we want to act as insurer? Or do we just want some sort of financial support mechanism in place there? So these are all questions I think that will need to be answered before we get a workable flood insurance model. So now I'd like to move and think about these same issues for earthquake. And I think we'll find that the solution might be very, very different. So next slide, please, Danica. Oh, sorry, I forgot about this one. Just one last cap here. What is one word that describes the challenge of designing a flood insurance solution? And we'll build a nice little word map to finish out our flood. We'll just give it another minute in case people have more responses. I think all these words here are showing why this is such a difficult challenge that we have. Issues of equity and fairness and affordability and indecisiveness and a lack of political will, I think are all important elements as to why we still don't have a national flood insurance solution. But I think we'll stop here, and I'm cognizant of the time, and now we'll talk about earthquake. So next slide, please, Danica. So we're going to go through the exact same process here. I have 6 points here pulled of issues about that we have for earthquake, and I'd like you to take some time and just rank these issues as from most important down to least important. And just note, if you don't pick tail risk and solvency, Alistair won't let you come back. I think voting has sort of slowed, Danica, so we could probably move to the next slide. Okay. So again, I'm going to thank you for those responses. You know, we see that tail risk solvency is most important, followed by low take-up and affordability. These challenges highlight why the status quo isn't working for us. So I'm going to do the exact same thing. I'm going to flip it around. If we were starting from scratch, what could earthquake insurance look like? Like, what kind of system would protect households and support market stability? So, and these actually look at some of the solutions that we've seen. We could have a mandatory offer requirement. That might support risk communication. I'm really thinking about in Quebec, if whenever anyone went to buy residential insurance, they had to be offered earthquake coverage. So that would be the main goal, but it probably would have limited impact. If we think more about that tail risk concern, you know, a public backstop or an excess of loss support, something to manage that tail risk. It manages tail risk, protects solvency. It doesn't actually address the protection gap. It doesn't actually address any concerns with that low take-up or affordability. We could have co-insurance with the government, so we could have a New Zealand-like scheme where the government covered some losses, private insurers covered some losses. I would share the risk between public and private sectors. But, you know, we have to ask the question, do we need a public entity to offer earthquake insurance? Whether as a co-insurer or in some models as the primary insurer. Is that really a solution that we need in Canada to develop a new entity? We could have a voluntary model with a with a public subsidy mechanism. So private insurers could still offer coverage, but potentially the cost of coverage could be reduced if there were a subsidy mechanism. You know, if it's still voluntary, we still may have low take-up without some sort of other outreach or initiatives, and we're still stuck with the key question, who would pay that subsidy? Is the important thing to improve coverage terms. So to reduce that coverage gap, but that's going to be costly unless we have some sort of other public risk sharing or some sort of regulatory relief. You know, I think the product looks the way it does because it's so expensive for private insurers to handle that risk on their own. Next slide, please. So thinking about some of the earlier design features that I've discussed that happen in other jurisdictions, which design features or interventions do you actually think could work in Canada for earthquake? And I'll give you some time to fill this out. Again, the same as before, you can put in multiple responses, but if you see a response that you really like, you can just wait and vote for that when we open the voting. And I know I didn't highlight this in the previous option, but I think this is one where I'd like to people think we need a national solution or we should have a province-dependent solution. We'll give it another minute and then we'll open it for voting. Danica, did you want to open it for voting? I'm just noticing the time here. So again, people are allowed to vote for 3 choices. Danica, I think we should show the results just so we can get that on time. You know, again, backstop appeared in a few different places. So I think if we went back and added up all the backstop, that might come up as number 1. But I think these responses really capture some of the complexity of designing a workable earthquake system, you know, from how risk is shared, how claims are handled, you know, how we deal with tail risk, you know, what are the responsibilities outside of the insurance industry to create a more sustainable earthquake resistant country. But we'll move on to the next slide. So again, that's the same as we did before. What would it actually take to make earthquake insurance work? So, and these are just talking about some of these trade-offs that we're going to have. So we have a trade-off between tail risk and affordability. Now, managing tail risk through public backstops or co-insurance would actually, you know, reduce capital requirements, should actually encourage, you know, lower premiums, but it could be potentially costly to the government. And so that might be where we're getting some of the pushback why we don't have a system yet. So that current capital standard that we have contributes, you know, to the safety of the system that supports solvency, having a 1 in 500 year requirement for reinsurance. But it also contributes to high deductibles, exclusions, narrow event windows, and high costs. What we also want to think about, you know, it came through here, some mandatory coverage with some of the choices picked by the attendees, you know, behavioral nudges, a mandatory offer, targeted outreach may improve take-up rates, but without a mandate, participation will likely remain low. The last word disappeared there. But there may be a lack of political appetite to make the coverage required. And the last thing I think we always want to think about as an industry is what is the role of private delivery versus the role of the government? So is the role of the government to act as a reinsurer or insurer, or just financially support the private insurance market? And if it's just financially support the private insurance market, what does that support actually look like? Next slide, please, Danica. So we'll do a fun little word cloud here. We won't take too long to do this because I see we're coming down to the end of the presentation. But what one word best describes the challenge of designing a Canadian earthquake insurance solution? So we'll open that word cloud to everyone. So affordability seems to be a critical component here. And as we've discussed, fixing other parts of this product might actually help fix the affordability. But I think in the interest of time, Danica, we should probably move to the next slide. So just some final reflections. I think what we've discovered is that even in Canada, when we're looking at two different perils, we don't have a one-size-fits-all solution. So we've seen, flood and earthquake are fundamentally different. Flood seems to be largely about affordability and availability, getting the coverage into the hands of the people who need it. Earthquake, although we highlighted there is an affordability element that potentially arises from the solvency and the tail risk challenge. We need to make sure that the system will hold together when the big one hits. And each will require a different kind of policy response. There is no perfect design. Every choice, whether it's about who pays first, how risk is priced, how claims are handled, they're going to require trade-offs between affordability, solvency, political feasibility, and how risk is shared. The right balance is going to depend on what we're trying to achieve. When I say the product is part of the solution, okay, is there an industry rep? Oh, we can pull that question up. That's a really interesting question. The government says that they would not step in. Well, actually, I think anything under your deductibles, you probably would be covered under DFAA. So DFAA will pay for losses that are not covered by insurance if you have purchased insurance. So I would suspect that the government would step in. The bigger issue would be that people who have not purchased insurance, the rules behind the disaster financial assistance say that if you have not purchased insurance when it was reasonably available and affordable, then the government will not provide money. Would the government actually not cover those losses? That would be, I think they did step in and cover a lot of the flood losses in BC a few years ago. So I would suspect it would be more of a reputational nightmare. But we all have seen the industry reputational risk after the Calgary floods in 2013, and insurers covered things where they weren't legally obligated to cover. Right. So when I say the product is part of the solution, but not the whole solution, so what I mean by that, the product itself matters. What's covered, what's excluded, how capital requirements shape pricing and participation. But I think the bigger issue that we need to answer is how and where should the government participate? Do we want them actually to be an insurer, or do we want them to be, for lack of a better word, a bank? They'll provide the funding, but the actual pricing, underwriting, claim settlement all sit within the industry. The right intervention is going to depend on the objective, and the best approach depends on the goal. What are we trying to do? Improve access, ensure solvency, make the system sustainable long term, and the tools that we choose, whether we're looking at subsidies, backstops, pools, they need to be matched to the problem we're solving. And again, the government roles are going to vary widely, and they're going to shape the program function. I personally, my belief, that the insurance industry has expertise in underwriting, pricing, and settling claims. I don't think that this is, again, my viewpoint, that we need to recreate a public insurer. A lot of the other public insurers that I've talked about have been around, since I think 1970, 1980, back when there was less capacity in the insurance industry. Now it's not clear that you would actually need that public participation in those insurance company roles. Next slide, please. So that's the end of my presentation. I want to thank everyone for being here and participating in the Menti activities. I have my contact info there, and that will be sent out when Ian sends out the slides tomorrow. But thank you very much. And back to you, Ian.
Thank you very much, Mary. We've been speaking with Mary Kelly, Professor of Finance and Insurance in the Lazaridis School of Business and Economics at Wilfrid Laurier University. a very topical issue and very engaging with the use of Menti. I know from satisfaction surveys, people love that. You'll see a copy of the slide deck and a follow-up email to members. And this presentation will live on our website. You will see that shortly posted as well. So if I can ask Danica to, there we are. So just quickly, our next event, 4 months away, so we're still pulling this together, but Neil Morrison, Chair Designate of Aviva Canada Inc. will talk about the board member perspective on ERM. We're going to have a session on the Ontario Auto Insurance Reform, and then over the summer, you're going to be participating in our ERM benchmark survey, and we have a panel that we've assembled, Sonia Kundi from Zurich, Tracy Mann from Definity, and Jean-Philippe Daigle from Desjardins, and myself will pour over the results of the benchmark survey. They're received by PASIC in confidence. Your answers are compiled and put in summary form, so there's no identifiers, and then we engage with the panel, and we're going to present that to you at our September 11th forum meeting. So our next event is 4 months from now. Enjoy your summer. Thanks for being part of this broadcast now, and take care, and we will be in touch. Thanks very much.